Hello everyone, welcome to Just Invest Today, and today we're talking about this huge market crash that's going undercover. All these high-flying stocks are crashing, and we just see it in the market again and again and again. But really, people aren't really talking about it as much, but if you really look closely, a lot of the high flyers are crashing. Look what's happening. PayPal, Twitter, Snap, Coupang, Twilio, 37%, 38%, 38%, 41%, 44%, 48%. Even Baba's at 56%, Teladoc 60%, Peloton 70%, man. And it's happening again and again and again. And there's still so many high flying stocks that are going to see crashing even more going into this, even continue on this year and even into next year. So we got to talk about it, see what we can do to kind of help us deal with this huge blow. If you have one of these stocks or you're dealing with at least a 30-40% drawdown, put the stock down below and tell me, how are you dealing with it? Or are you just kind of selling it off? Are you keeping it? Do you still believe in the company? Because we have to find ways to actually make sure this doesn't really happen all the time to you and you're able to just take it and just be okay with the 50% drawdowns, 40% drawdowns. So guys, can you please like this video, subscribe to my channel, man. I'm always going to provide you with good content. So we're going to get into some reasons why this is happening, right? Because this is pretty crazy when you really think about it. Look what's happening with Palantir. The high was around 38? Look at that. 43% decline. Wish was a high flyer, man. All that pre-pandemic, pandemic type companies, boom, 85%. If you own Wish, can you please comment down below? Did you sell off? Are you keeping it? Do you still have high hopes for this company? Even me, I'm dealing with the same thing. Look at this from the highs. What was this, around 270? 49% drawdown. So just so many huge drawdowns going on in the market, and you just have to understand why this is happening and just how to deal with it. So the first reason why this is happening is because we understand that the whole pandemic made these evaluations just erupt. Everyone was staying inside. So all these companies like Wish, like Palantir, like Peloton, like Beyond Meat, all these companies had such high evaluations, man. And people thought these companies were just going to be successful. They had just so many people wanted to buy their products and all that good stuff. So those stocks all just took off, right? So that is one of the reasons. The second reason, these stock options. Look at this. Stock options are the new day trading craze. What it means for the market. Hot stocks like Tesla and Apple have become even hotter as stock option speculators sweep back into the market. Many are the retail investors holding their positions for less than a day. A new day trading frenzy in options is helping lift individual stocks and bolstering the revenue of online brokers like Robinhood. So that's what's happening in the market. If you're not paying attention, is that all these high flying stocks are just surging with options. Think about AMD, Nvidia, Tesla, Apple. All these high flying stocks are just surging with options trading. Think about GME, AMC, all those stocks, and it's still it's the second highest point. It's 56 million options just trading daily, and people are only doing options for a week maximum, a day. So you're just seeing what's happening in the market, and this is when it's so important to listen to people like Charlie Munger. They give you the best advice. It's in the nature of the stock markets to go way down from time to time. There's no system to avoid bad markets. And that's what's happening. You can't avoid the bad market. It's going to happen. You can't do it unless you try to time the market, which is you just can't time the market. It's a mistake. If you try to do it, you're just going to get crushed, which is a seriously dumb thing to do. Conservative investing with steady savings without expecting miracles is the way to go. So you have to be extremely conservative, understand what the company is doing, what it is, and that's how you beat these huge drawdowns. Look at this impressive from Twitter. In bear markets, stocks return to their rightful owners. I like that quote. In the bear market, the short-term investors, traders, speculators, and weak investors forced to sell their good quality shares. All good quality shares are bought by smart and long-term investors, and that's how you gotta look at it, man. Because all the shares are going to return to the people that are actually really in the company and honestly just want to be in the company because it's actually a long-term pay. They're not speculating on it. They're not looking for short-term movements. So the rightful owners of the people who think of the business like it's their business, like they just really, really want to own it, those are the people that are going to be in those stocks when you see those 40-50% drawdowns, man. So that's what we have to just keep memorizing in the back of our head, is that these sell-offs are just mandatory. Charlie Munger says again, like, if you can't take a 50% drawdown, why are you in the market? Like, there's no reason to be in the market right now. And like, things like these stocks have in common, like, they have such huge expectations. That's another reason why these stocks are all falling down. If you're buying into stocks that don't have enough, they're not generating actual money and actual net income, the chances of it crashing are even more likely. And when analysts put these high expectations on these companies, the likelihood of them just always having to beat analyst expectations, always having to have high margins, there's a better chance of it crashing down. So understand, like, are you in stocks that have these huge expectations, and then do you think they can even meet those expectations? Are they realistic? And that's what happens with companies that just have high revenue growth but have no earnings, and that have been just kind of running because they felt all that good money flow from all the pandemic and all the people just buying into the company because they had nothing to do. So that's why you're seeing all these companies taking these huge just drawdowns, like Zoom, Roku, Pins, like Upstart, like all of these companies. Bull market is actually helping a lot of these companies. The bull market is just making sure that these companies still look very strong and just helping them out. They're kind of masking all the problems might this company have, right? So if it wasn't for the bull market, people are actually going to start looking at the cash flows and what the company is actually generating, because then they're going to be like, oh, I actually want my cash back. So a lot of these companies don't generate revenue, or they're not strong companies that actually generate strong income for the shareholders, comparing it to the price. So when you compare it to the price and they're not generating enough income, you're going to want the actual cash flows, because that's what you're actually promised from the company. And if you're not getting that, then you're just going to be like out of the stock. And the bull market is literally hiding all of that. Because when that bull market crashes and everything crashes, people are going to start looking for the actual cash flows. And who knows what's going to happen? Is it going to be stable? Is that ever going to recover back? So you have to watch out for that. So what can you do about all of this and how you're thinking about the market and the companies that you own? So the first thing is that, are you gambling? Are you just in the company for the short term? You really got to reevaluate all the stocks that you own and see if they actually have like the potential of being really good long-term compounders, because that's going to mask everything. Like, if you have a company, like say me, I own Baba, it's down 40-50%, whatever. I'm okay with that because I'm in it for the long term. I don't have a problem. The company is still dominant and strong. So it doesn't, like, I don't lose sleep about it because I still know the company is well run. It's still dominant and still gonna produce a high amount of net income and actual cash. So what kind of company do you own? And you have to look in your portfolio and analyze that. The second thing, does your company have a competitive advantage? Because that's what it's going to come down to when the bear market hits. Does your company have a competitive advantage? Is it going to stay long term, like 5-10 years down the road? And you need that moat, you need that competitive advantage, because you have to be able to predict the future. And it's so hard to predict the future. The more you try to predict it, the more you're likely to be wrong in that prediction. So the way that you can protect yourself the most is having sound companies with strong balance sheets that don't need to go to the market to get capital. Because when there's a huge downturn, is that company still going to be able to get the capital from the stock market or from debt if the interest rates increases? You don't know. So you have to make sure you have companies with most competitive advantages generating a lot of income, plus sound companies with strong balance sheets. So That's what you need to look for in case stuff happens again. There might be another 50, 60, 70% drawdown, and you might be looking like a fool when it comes to that, and you don't know when it's going to recover, if it does recover. But that's why you have to get these strong companies with competitive advantages, man. So that's it for the video. Tell me what you think. Do you own any of these companies with these huge drawdowns? You know, I own Baba, has over 50% drawdown. So like this video, subscribe to my channel, and I get back to you in the next video. Peace.